Well, it's a great pleasure to follow Andre. One of the great joys of teaching is having wonderful students like Andre and his son Sam, who one day may outstrip their teachers. So, both of them. So, so I'm talking about the leverage cycle, and it's going to touch on work that I've done with a bunch of students and with Bill Zane. So the idea of the leverage cycle is simply this. When leverage goes up, in good times, asset prices go up. When leverage goes down, asset prices go down. That's the story of the leverage cycle, and I think that has a lot to do with the story of what happened in the crisis. That's what I'm trying to argue. This kind of story, I think the antecedent, the boom-bust story, was told maybe by Minsky and Kindleberger, but as you know, in none of them, there was no model, no mathematics in either of them, no collateral, and they were driven by extrapolative expectations, not the subtle kind like Andre's, but they were irrational expectations. So I'm going to diverge in all three of those areas. Now, who introduced collateral? Three wonderful papers. Bernanke, Gertler in '86, that's when I read it. It got published later, I guess. Holmstrom, Tirole, and Kiyotaki Moore, both of them in '97. The top two, I call that a corporate finance approach to leverage. It's, there's asymmetric information. You have to monitor. The guy might steal the money, something like that, and that has to do with how much you'll lend. Kiyotaki and Moore is more like what I do. It's simpler. It's the collateral is there. You either pay or you get the collateral. That's become one of maybe the canonical model of macro, the two-agent infinite horizon kind of model. There was a fourth paper written at the same time, which got a lot less attention. But it deals with many of the same issues. It's a more abstract general equilibrium trying to prove theorems kind of paper. But the main difference is that it's focused on how leverage is determined. Those other papers, they weren't worried about leverage. They weren't worried about changes in leverage. I was worried about changes in leverage. So I'm going to describe that now. So as I said, there are no costs or information asymmetries. It's general equilibrium, just like Arrow-Debreu, based on that kind of thinking. So the puzzle I began with was very simple. How can it be that one supply equals demand equation can determine not just the interest rate, which is the price, but also the amount of leverage, the amount of collateral? Same thing, leverage is the inverse of collateral. How can one equation determine two variables? I was just baffled by that. So in a standard theory, supply equals demand would determine the price, that is the interest rate, but I'm going to show how supply and demand can determine leverage on top of that. So the paper began with the thought that for every pair of a promise and a collateral, not just a equilibrium by supply equals demand. So what you get out of that is the first concept is a credit surface, I call it. So once you have for every contract, for the promise, you have a price of the promise, but you also have a price of a collateral. So if you take the ratio, the price of the promise, that's how much you can borrow, divided by the price of the collateral, that's the loan to value. The value of the loan divided by the value of the collateral. Those are both prices in equilibrium. And the interest rate is just the promise divided by the price of the pair, and so that's the interest rate. So every one of these pairs gives rise to a point on this graph. And so when the promise is small enough, the collateral is going to cover the promise no matter what, and as the promise gets bigger and bigger, the interest rate stays the same because there's no worry about default. After you pass a threshold, the lenders start to worry about default, and in order to get enough money in the good state to compensate when there's default in the bad state, the price is going to have to reflect it, and the interest rate has to go up. So that's the crucial concept, and borrowers are choosing whatever point they want on this credit surface. Lenders are choosing whatever point they want on the surface, and in equilibrium, there has to be demand equals supply at every point on the surface. So this solves one of the puzzles for me about macroeconomics. The old macroeconomics, not what we do now, but the old macroeconomics always had, the Fed moving the interest rate up or down depending on whether there was too much activity or too little activity. But if you have that view of macroeconomics, what does tight credit mean? That the interest rate is too high or too low? I don't think that's what both what business people mean. They mean that at the going interest rate, they can't get a loan because people are afraid they might default. So that's what's reflected in the credit surface. It's not the interest rate that you're being charged for your loan, it's how steep the credit surface is, because if you wanted to get a bigger loan with the same collateral, you'd have to pay a higher interest rate. It's the steepness of the credit surface that reflects the tightness of the credit market. So the blue thing is a looser credit market, the red is a tighter credit market. And it may be that in both credit markets, people are paying the same interest rate. But the fact is, there's a later point at which the interest rate starts to go up. So that's what I mean by loose and tight. Now, how can I connect this to volatility and to asset prices? Well, the first idea is going to be low volatility makes for high leverage. But how can you get that out of the credit surface? Of course, this is something everyone on Wall Street knows. When they set margins in the commodities market, for example, it's clear that the margins are reflect the underlying volatility of the asset. I think what I contributed in 2003, that was after 97, was the idea that even in macroeconomic settings, volatility is going to affect credit markets and how easy it is to get credit. This is a theme of Brunemeyer and Peterson from 2009. So if you look at the volatility of some commodity like oil or soybeans or something like that, and you look at the margin, you see that they're highly correlated. The more volatile, the tougher the margins. You look at past volatility, that also predicts margins too. So now, I want to connect volatility to leverage in my credit surface thing. So let's think of a binomial economy. A binomial economy is arbitrary preferences, but only two states tomorrow and a state today. And the asset we're talking about is going to pay more in the upstate than in the downstate. So there it pays more in the upstate than the downstate. So if you make the 45-degree line represents the kind of promises you can make with the collateral backing the promises. For small promises, the collateral is going to cover it completely, and the delivery is going to be equal to the promise, and there'll be no default. For a bigger promise, in the bad state, the collateral is not big enough, there'll be a default, and so delivery is less than what's promised. And by the blue line, the residual is what the borrower gets by holding the collateral, leveraging it, and borrowing the net. This max-min contract is the most important one, the maximal promise at which there's no default. And so the delivery is equal to the promise. So the theorem I proved in 2003 for a special case of risk neutrality, Anna Fostel, a student of mine who teaches at Virginia now, professor at Virginia, we proved a more general theorem that in any binomial tree, any binomial situation, like I just described, the following is going to be true. It depends on this distinction between a financial asset and a non-financial asset. So a financial asset is an asset whose payoff doesn't depend on who's managing it, or at least not on the person who's using it as collateral. Doesn't depend on who's managing it, and also it doesn't depend, the holder doesn't get any utility out of holding it. So I'm thinking of shares of General Electric stock. You could put that up as collateral. A securitized mortgage share, security. You could use that as collateral. You could put things up on the repo market. Those are financial assets. A non-financial asset is something like a house you're getting utility living in, or a factory where you're managing it, and what you do affects how much output there's going to be. So sometimes these get mixed up. But the theorem is that in these binomial worlds, if you have financial assets, then in equilibrium, no matter what the preferences, anything, completely general, the only contract that will be traded is the max-min contract. So there'll be no default in the binomial world. It makes it very easy to think about. The shortage of collateral is going to limit the promises because no one can default. The collateral has to promise them. So the threat of default is very important, but there is no actual default. So I think of this as, but it's not true for other markets like the mortgage market where you've got the house, where you're getting utility. So I think of this as like a repo market where the loan is very short term and you can think of only two things happening in the very short run, and so there'll probably never be any defaults, which there virtually never is on the repo market, even during the Great Crisis. Okay, but it's not true for non-financial assets. So for financial assets, you'll never get an equilibrium situation like this. It'll always be like that. Or to put it in our picture, all the borrowing will be at the point A. With a non-financial asset, you might get people choosing to lend and borrow at point B. But with a financial asset, it will always happen at A. So it's a very crude, simplified story, but it allows me to tell a very simple lesson, draw a very simple lesson, that the amount of borrowing just depends on the down risk. When there's less, a better payoff in the down state, you can borrow more. So you could, there's a theorem. It says less down risk means higher leverage. And it also turns out that you could relate this to volatility in the two-state world. So it's like saying less volatility means higher leverage. Okay, now what about leverage and asset prices? Well, so as I said at the beginning, higher leverage means higher asset prices. But what's the argument for that? Well, it's actually not true in general, but if the interest rate stays the same, this is why it matters, maybe the global financial, global savings glut. If interest rates stay the same and you leverage more, and people are allowed to leverage more, something in the economy happens, less volatility, they can leverage more, the asset prices are going to go up. Why? Because leverage lets the people who really want to borrow the stuff get their hands on more money, of course. So demand goes up and the price goes up. So that was the theme of my leverage cycle. So as I said, it's completely obvious, but no one seems to have concentrated on this before except possibly Minsky. So all of those other models that I told you about in the 90s, there was a famous accelerator which has a similar feel, but it's not the same thing. In that story, as the asset goes up in value and you can borrow the same percentage, you'll be doing more investing, and that might have a feedback on making the asset more valuable. So it's the multiplier accelerator, something like that they call it. A very important concept. This is a little bit different and more direct. It says the percentage you can borrow when the asset doesn't go up in value. The percentage you can borrow goes up, and that drives the asset price up. So how do you prove this? It's another similar thing. So Anna, again, with me, proved a theorem. We said, let's look at these binomial economies. An N economy, when you can't leverage, or you're limited to leveraging less than you would in the equilibrium of what I call the collateral economy. In the L economy, you can leverage as much as you want by making non-contingent promises. And of course, in equilibrium, we know that's a 1. That isn't me. No. Okay, thanks. We're down to 10 already. Okay, in the Arrow-Debreu economy, you can borrow as much as you want. So the theorem is that the price in the leverage economy is always going to be higher than the N economy. Being able to leverage is going to make asset prices higher. A surprising theorem, I think, is that as long as there's no output, no endowment in the future, so all the endowment and consumption comes from assets today that pay dividends, then the leverage economy asset prices are higher than in the Arrow-Debreu economy. And of course, this requires heterogeneity. The strict inequality requires heterogeneity. The people who want the assets by leveraging more can get their hands on the money from the people who don't want them and bid the price up. So it's a little bit paradoxical. You would think that the need for collateral would limit borrowing and therefore limit the price of things people are borrowing to try and get their hands on. But the second theorem proves, no, the limitation to borrowing can actually increase the price beyond what it would be when you could borrow as much as you like. So Arrow-Debreu allows for more borrowing, and you get a less high price. So how could that be? It's because in order to borrow in a collateral economy, you have to hold the asset. In order to bet on something going up, you have to hold the asset and leverage it. That's how you bet on the upstate. In Arrow-Debreu, you just bet on the upstate without having to hold anything. So the need for something as collateral can make its price even higher than what it would be. You're limiting in how much you can borrow to get it, and yet the price is even higher than it would be in a frictionless world where you could borrow all you wanted to buy it. So the two things that it's easiest to borrow in America now are housing and education. Those are the two things that have had the highest boom in prices. So higher leverage makes for higher asset prices. So what's the mechanism? The mechanism is that low volatility. By the way, I started it. Yeah, I think you might be off by a few minutes. Okay, so low volatility. If we subtract for your 5-minute introduction too. So low volatility makes for high leverage, makes for high prices. Okay, and if you have a shock that increases volatility, that's the volatility leverage mechanism, then you go to a high volatility, which makes for low leverage, makes for low prices. That's the main theme of the leverage cycle. Low volatility, high leverage, high prices, something happens, you get worried, high volatility, so the lenders don't lend much leverage and the prices go down. But there's one other mechanism, which is the wealth distribution mechanism. So when these heterogeneous agents, when they borrow a lot of money, okay, and the question is, when they borrow, so when you have high leverage and high prices, you get borrowing going up for a squared reason. It's a higher percentage of a higher number. So there's huge borrowing. High debt, enough high debt makes for a fragile economy. This is related to what Olivier was talking about. I think it's quite interesting. So what happens is, if you've borrowed a tremendous amount of money, you have to sell something to pay it back. Suppose you have to sell houses to pay back. The people who most want to buy the houses are now having to sell some of them to pay back. When the prices of housing go down, their demand should go up for housing, but because they're in so much debt, they have to sell more housing because the prices are lower to meet their debts. And so demand is downward slope, goes, when prices go down, it goes down instead of going up. So basically, you can prove a theorem that in any economy, if you increase debt in the right direction, you're going to create a fragile economy. And if you increase it still further, you're going to create multiplicity. So you have to think outside the Edgeworth box to get this. As a general theorem, no matter how many people, commodities, anything, there's an equilibrium with no trade. Here the endowments moved up. So in equilibrium there is trade. There's going to be income effects now because people are trading. When you're selling something, the price goes down, you're poor. If you make it big enough, the theorem says eventually it's going to be fragile. If it gets really big, you're going to have multiple equilibria because demand will be upward sloping. So combining those two mechanisms, low volatility produces high leverage, produces high prices. You now have a fragile economy because of so much debt. So just a small shock that also creates more volatility is going to cause a tremendous drop in prices. That's the leverage cycle. Okay, a scary bad news. It's not so dramatic, but it causes uncertainty. That's going to, for two reasons, cause. So scary bad news is the heart of the leverage cycle, and you see that actually it's a common thing. If you look at the change in VIX relative to the change in the S&P, it turns out that most bad news creates more volatility. So the leverage cycle is a long period of low volatility and financial innovation. So there's a continuation of this I didn't have time to talk about. When you can tranche things, it's like super leverage. So since collateral has an extra price because it's valuable as collateral, you have a great incentive to use it again and again and to tranche it or pyramid it and stuff like that. So as long as nothing wrong is happening, you have low volatility like in the Great Moderation, leverage is going to go up, financial innovation is going to create more leverage, and you're going to get laxer credit standards, okay? Laxer credit standards. That raises asset prices, increases activity, but makes the economy more vulnerable. So a little bit of bad news can cause a great crisis because of the income effect. First of all, there's the bad news, then there's the income effect that the most leveraged people with a high marginal propensity to consume people, they go out of business. And then lastly, the new buyers have a very tough margin, so they can't borrow much money. And if the gap between prices and if the gap between what the asset's worth, which has fallen, and the debt is big enough, the only thing you can do is forgive some of the debt. It's the only solution. So that was the leverage cycle. So you should empower central banks to regulate leverage, put endogenous leverage, changing leverage and credit surfaces into macro models, and destigmatize default. So all these ideas are in Shakespeare. There was, as you remember, in The Merchant of Venice, they negotiate over a loan. Nobody can remember the rate of interest, but everyone remembers the collateral, a pound of flesh. There's the ships apparently sink, and there's a margin call, and in the end, there's forgiveness. So the whole story is in The Merchant of Venice. Now, there are closer antecedents. There's Slave for Vishny, the arbitrage buyers. I said Brunemeyer Peterson, 2009, came afterwards, but very related uncertainty shocks of Bloom, 2009, and different beliefs. So as I said, theory doesn't have anything to do with differences in beliefs necessarily. It's heterogeneity. You can have difference in risk tolerance, different uses of the asset, difference in ability to hedge, or just more optimistic, which is what I have. So I'm going to, you could tell a similar story about leverage. Schiller told me by having just irrational beliefs of lenders. They get enthusiastic and lend more. But anyway, so back to the basic leverage cycle. It's leverage up, asset prices up, leverage down, asset prices down. The key driver, as I said, is volatility, rationally anticipated. But I accept Andre's suggestion and Schiller's that, irrationality and not correct beliefs could create a lot more feedback effects and be relevant. So this is different from the credit cycle, which doesn't involve changes in leverage. The change in leverage is crucial to all this, and some other papers on the credit cycle have leverage for new loans going in the opposite direction. In the crisis, there's more leverage, whereas the heart of this is there's less leverage in the crisis. So the way I told this in 2003, I'm going to just mention it, has all these ingredients. And how did it work? You had a 3-period model where there was an asset that could pay 1 in the top 3 states, or 0.2. So you notice after good news, it's going to pay 1 for sure. After bad news, it's uncertain. So that's the scary bad news part. The difference between people is that some people, the optimists, think the probability of going up is H. They're H close to 1. The pessimists think H is close to 0. And there's a continuum of them uniformly distributed. They own 1 unit of X, which pays 1 for sure at the end, and 1 unit of Y and nothing in between. So what'll happen in this economy? They can borrow 1-period promises. They can create 1-period riskless promises, 1-period non-contingent promises. So what's going to happen in equilibrium? Well, what's the price going to be at 0 and at D? At U, it has to be 1 because the payoff of the asset is 1. So the answer turns out to be it's extremely high, 0.95 at 0, and very low, 0.69 at D. That's a 26-point drop. Nobody thinks himself that the asset price should have dropped so far. If you're a pure optimist, H equals 1, you still think you're going to get a payoff of 1, so you don't think there should be any drop. If you're a pure pessimist, H equals 0, you think it's 0.2 and it's going to end up being 0.2. Everyone's risk neutral. So so nobody thinks it should drop so much. So why does it drop so much? Well, it drops so much because at 0, the next step, which was 1-period loans, the worst that can happen is 0.69. So leverage is very high, and only 13% of the people, by borrowing a huge amount of money, can buy all the assets. And the price reflects the marginal buyer, who's 0.87. But when you get the bad news, what happens is that the people who are leveraged so high, they get wiped out. So they disappear, and the people who are left, all the way from there to the people who are left now aren't as optimistic. So you've got the wealth effect. It's less optimistic people now have to hold it, but it takes many more of them because they can't borrow anymore because leverage has gone way down. So the marginal buyer goes from 87 to 61, and the big drop in price comes not from the bad news, so 87 thought it was worth less. It comes from the fact that it's a new guy valuing it. So here's the change in the credit surface from 0 to D. So a huge tightening of the credit surface. So one more thing. One more thing is that the drop of 26 points is bigger than anybody thought. Actually, there's rationality. Everybody's updating their beliefs by Bayes' law. In fact, the reason the price is only 95 at the beginning, 87 is the marginal buyer, 86 didn't buy, even though if you calculate 14% multiplied is 2%. So Mr. 86 thinks the price should be 98. That's Warren Buffett. He didn't buy because he's waiting for the crash, where he's going to make a bigger return if he buys later. There just aren't enough Warren Buffetts to prevent the crash. And also you explain why there is a maturity mismatch. These people who buy, and then over here they get a margin call. They have to sell their asset to pay back the 69 they use. If only they could hold on to the end, the asset would be worth 1, and they could pay back the 69 and have a huge profit. The fact that there's a margin call and they have to sell here is what destroys their profit. Surely if they had a long period loan, they wouldn't face that problem, and there wouldn't be any disaster. But see, in the model, you don't take out, if you had available a 2-period loan, because there are only 2 outcomes in the end, in equilibrium, the only amount you could borrow would be 0.2, and it wouldn't be worth it to borrow only 0.2 to avoid that downside. You prefer to borrow the whole 0.69 and buy more assets, even though you get crushed in the down state. So I also wrote a paper with Anna in which we had multiple leverage cycles. One leverage cycle is contagion, gives rise to another one because there's a search for collateral, a run to collateral. So I'll finish with 1 minute here with just a few pictures that this illustrates. Okay, time's going slower now. I like that. Thank you. these Scots are not so bad after all. So anyway, so here is, we kept at my hedge fund a record of the loan to value or margin we had to put on all the assets we buy. And we did this after the 98 crisis, where I got a lot of these ideas after the 98 crisis. So there was a huge drop in LTV for the prime mortgages that we were buying, and then it quickly returned. In fact, leverage went even up towards the 2004, 2005. The asset prices stayed pretty much that we were buying, at par. These are AAA bonds, subprime, some of them. But then you notice during the crises, leverage collapsed and the asset prices collapsed. And after the crisis, leverage went back up and the asset prices went back up. This blue line is Shiller's index of housing prices, 90% rise and then drop, in 6 years. But here's the record of loan to value on all non-government loans, actually subprime and Alt-A loans that were securitized that my hedge fund got all the data from, all subprime loans, and what the loan to value was in there for those loans. This is the average of the top 50%. And you see that there's a collapse in leverage just as the housing prices go down. It didn't happen just because of irrational exuberance, although that might have been part of it, or these expectations of Andre. They also happened because it got harder to borrow. So if you look, a paper of Lansing's, if you look at Glick and Lansing from the Federal Reserve Bank in 2009, like Mian and Sufi, you look at the jump from 97 to 2007 in debt to household income for a bunch of different countries, Ireland and Denmark, and you see huge jumps. And then for two countries, Germany and Japan, almost no jump. And then you look at what happened to housing prices. Ireland's housing prices went up. Germany and Japan, they didn't go up at all. And who lost the most? Same people, Ireland, et cetera. And Germany and Japan didn't. Okay, I'm done. So just to finish, volatility does follow the pattern I was saying. Here's changes in VIX versus S&P. When the S&P is going down, volatility is going way up. There was a huge spike in volatility. The world was so uncertain in the crisis. Okay, and so what was the thing that started the uncertainty? I think people are saying panic because, what was it that got people so uncertain to begin with? Okay, well, here's my answer. What happened was leverage had kept going up, that housing prices couldn't go up much more because leverage was reaching such a high level in these subprime borrowers. But what happened was this market collapsed. This is the BBB market. These aren't riskless markets, by the way. And why did they collapse? Because here's the uncertainty: liquidity. The delinquencies of countrywide mortgages suddenly changed. They always go to 2%. Here, the last vintage, 06 vintage and 07, had shot to 5%. Still a trivial number, but made people worry. Maybe it's going to get much worse. So that's it. My story of the leverage cycle is it's over leverage followed by some scary bad news that's bad, not so bad, but creates a lot of uncertainty, changes the way everyone can leverage. You have to make the homeowners put down more if they might, they might, in order to sell the BBB piece of the mortgage, and so that creates a collapse in housing prices, and that causes the crisis. Sorry, I went over. Thank you.